Today, I'm going to teach you a simple yet powerful price action strategy that has the potential to deliver 100% profitable trades. Yes, you heard that right. If you're someone who's tired of complicated indicators, cluttered charts, and confusing signals, then this one's for you. This strategy is clean, easy to understand, and best of all, it's based on pure price action combined with the Fibonacci tool. Now, don't worry if you're new to Fibonacci. I'll walk you through how to use it step by step. You'll learn how to identify high probability zones, perfect entry points, and smart exits, all using just the Fibonacci retracement and some simple candlestick confirmations. Trust me, once you see how effective this strategy is, you'll want to use it every day. Before we dive into the strategy, there's one important thing I need to clarify. You see, most traders use the Fibonacci tool in a very standard way. They draw it from swing high to swing low or vice versa. Look for typical retracement levels like 38.2, 50%, or 61.8%, and wait for a bounce. And while that method works for some, I've discovered a unique way of using Fibonacci that's a bit different from what you might be used to. Over the years of trading and testing, I've developed my own twist on the Fibonacci method, and let me tell you, it has brought me consistent profits, trade after trade. So if you've tried Fibonacci before and felt like it almost worked, or if you were never fully confident in your entries, this method might just change the game for you. Stay with me, because what I'm about to show you could completely shift the way you look at market entries and exits. Let's start with the most important part of this strategy, identifying a very unique and powerful candlestick pattern that most traders overlook. Here's what you need to look for. In a downtrend, keep your eyes open for a big red candle. This tells us that sellers were clearly in control. Now, immediately after that, we want to see a smaller green candle, but there's a special detail. The red candle's close should be equal to the green candle's open. This is a subtle yet powerful clue. It shows us that even though sellers pushed the price down, the buyers picked it up exactly where the last candle left off, creating a potential shift in market sentiment. This pattern can also appear in the opposite direction during an uptrend. A strong green candle followed by a small red candle where the green candle's close equals the red candle's open. These equal open-close candles are like quiet signals from the market, hinting at possible reversals or strong reaction zones. Look at this example on the chart. Big red candle, followed by a green candle with a matching open. And here too, the same pattern, repeating like a hidden rhythm in the market. Once you identify this setup, here's the next step. Draw a horizontal line exactly the point where the red candle closed and the green candle opened. Forget about the wicks for now. We only care about the body of the candle. This line becomes your key level, a hidden support or resistance that we'll use for precise entries. It's clean, it's simple, and it works beautifully with the right confirmation. Now we need to do one more important step. Look below that top level and search for another similar candle pattern, one that follows the same logic. Once you spot it, we do the same thing. Draw a horizontal line at the body close level, ignoring the wicks, just like we did before. Now here's what we've got. Solid lines, one at the top and one at the bottom, both based on the same reliable candle structure. This gives us a beautifully defined price range, a zone that the market has reacted to in the past, and one that we can now use for the next step. This is where the strategy really comes to life. We'll now take the Fibonacci tool and apply it from the top line to the bottom line, or vice versa, depending on trend direction. This gives us key levels within that range where the price may bounce, reverse, or break out. What we've done here is not just draw random lines or use the Fibonacci blindly. We've combined price action plus Fibonacci to create a custom zone that actually means something. This combo of candle structure and Fibonacci makes our setup far more accurate and gives us a clearer roadmap for planning our trades. Once you apply the Fibonacci retracement between those two lines, either from top to bottom in a downtrend or bottom to top in an uptrend, don't forget to tweak the settings. This is super important and something many traders skip. Go into the Fibonacci tool settings and enable these specific levels. Now you might be wondering, why these levels? because each of them has a special role in how price reacts. A 0.382 and 0.618 are classic retracement zones, perfect for identifying pullbacks and bounce areas. Zero point 0.5 is a psychological level where the market often pauses or flips. One acts like a boundary. If price breaks it, something bigger may be brewing. And 1.618, that's your golden extension level, perfect for targeting breakouts or trend continuation setups. These levels aren't just numbers, they help you understand the story the price is trying to tell. When might a reversal happen? Where could a bounce occur? Is this a real breakout or just a fake out? Could there be a retest before continuation? With these levels on your chart, the market suddenly starts to make a lot more sense. You're no longer guessing, you're following a framework. We're finally ready to take trades based on real logic, not just guesswork. Up until now, we've done all the groundwork, identified our special candle patterns, marked two solid lines based on price action, applied the Fibonacci retracement, and it enabled the key levels. And now we wait for price to come into our golden zone. Personally, one of my favorite entry points is the zero point 0.5 Fibonacci level because it's that sweet middle ground, a place where the market often pauses, reverses, or flips direction. It's like a balancing point between buyers and sellers. So as soon as the price touches that zero point 0.5 level, I get ready. In this case, I see the market pull back nicely to zero point 0.5. The candle structure looks clean, and there's no sign of heavy rejection. So what do? I confidently take a buy position here. But wait, it gets even better. As I'm watching the chart, I notice something else that gives me extra confirmation. The market had already started pulling back from the 0.382 level earlier. That's a classic sign of healthy price action. When the price respects both 0.382 and zero point 0.5, it tells me the buyers are stepping in and the pullback is controlled and clean. Together, this gives me strong confidence, so I go ahead and take another buy trade. This layered confirmation approach is how I reduce risk and increase accuracy. I'm not trading every candle, I'm trading with purpose. Take a look at what's happening now. You can clearly see the price flipping from the zero point 0.5 level, just like we expected. That level, which often acts as a turning point, has once again proven its power. Now the price is pushing upward and trying to break the 1.0 level on our Fibonacci retracement. And that's a big deal because the 1.0 level is like a boundary, almost like a doorway between normal retracements and potential trend expansions. Think of it this way. If the price respects the 1.0 level and reverses, it might stay range bound. But if it breaks through the 1.0 level with momentum, just like it's doing now, it often signals that something bigger is brewing. It's like the market saying, I'm not done yet. Let's go higher. So what do? I set my target at the 1.618 level, one of the most powerful Fibonacci extension levels. Because it's not just a random number, it's part of the golden ratio, and price tends to respect it beautifully in strong trends. This becomes my final target zone, the sweet spot where I look to book profits and secure a strong win. This is the power of combining candle patterns plus price action plus Fibonacci. It gives you a complete roadmap with high conviction trade setups. Now, here's a classic example of why observation and flexibility are key in trading. At this point in the trade, I had a feeling the price is looking strong. Maybe it'll push even higher beyond the 1.0 Fibonacci level. So I went ahead and made a small adjustment. I raised my target profit level just a bit higher, expecting a potential breakout. But here's the thing. Um, the market had a different plan. As I continued watching the price action, I noticed that the candles started slowing down right at the 1.0 level. Instead of breaking through with momentum like before, price began to move sideways, showing hesitation. And that's a key signal for me. This kind of movement usually means the market is losing steam and it could be getting ready to reverse. So, what did I do? I trusted the structure, stayed disciplined, and adjusted my target profit back to the 1.0 level, the very same level price was respecting. And guess what? Boom! The price hit the 1.0 level perfectly, triggered my target, and closed the trade with a solid profit of nearly $1,000. This is why it's so important to read the market like a story, not just chase numbers blindly. You need to adapt, follow the price behavior, and let the market tell you what it wants to do. And there you have it, a clean setup, a smart adjustment, and a confident exit with profits in hand. Thanks a ton for watching. If you found this helpful, please don't forget to like, share, and subscribe to the channel. More simple, powerful strategies coming your way soon. Let's grow together and trade smarter every day.